Good afternoon. This is Brad Dennis with BIS Commodities with your market wrap up for the first week of July. First off, this morning, 7:30, beginning of the month, we saw non-farm payrolls. They came out at 222,000. That was versus ADP's estimate of 158,000, so much better on the non-farm payrolls, plus revisions for the past 2 months. The unemployment rate went up to 4.4%, and our earnings stayed at 0.3% better. So not a real big change in that unemployment rate, but the non-farm payrolls were better than expected. And that's given a little bit of a bid to stocks here at the end of the week. Mostly stocks have seen lower prices as we still see a lot of not tension, but just nothing getting passed through Congress right now with Trump policies, and that's kind of, people are starting to give up a little bit on what this administration set out to do. They're not seeing a whole lot of things being done in Congress, and that's kind of put a little bit of a sour taste into people's mouths, and that's why equities were off a little bit this week. Over in the energies, crude down today. Yesterday you came in, you saw that they had a much larger draw than people had expected, over 6 million barrels. Everybody thought that that was a bullish sign, and it really is. But the overwhelming attitude towards crude right now is that Russia's not going to cut production as OPEC would like them to do. So without Russia cutting production and maybe flooding the market, so to speak, that'll push prices down as well. Kind of interesting to note that we continue to export a lot of crude. Some of our highest numbers go to China now, 180,000 barrels, I believe, per day. So with shale increasing its production levels, we're starting to get some of that crude out, and that is putting a pressure on the market as well. We'll have to see if OPEC, Russia can't come into agreement. We've definitely seen a little bit of a trend of these inventories drawing down in the U.S. here, so that could give us a bounce. I imagine we'll go back down and retest our most recent lows, though, first. Over in the grains, we're looking at weather. We're also looking a little bit at demand. With corn prices having rallied up about 30 cents over the past week, we're starting to see a lot more business go South America's way. Their safrina crop coming out of Mato Grosso is far enough along that they're filling up the pipelines for export sales, and they are shipping out corn, stealing that export business from us. And we saw that reflected in our export sales numbers this morning, as we had the lowest number of the marketing year on corn export sales. Weather, still a factor out there. We're still also watching this short covering rally unfold. Minneapolis wheat saw a dollar range in the Septembers on Thursday, 94-cent range. So we did peak it up there, saw a little bit of profit taking come off, and today was a much milder day with Chicago wheat closing a little bit lower. So without Minneapolis wheat pulling up the corn market, it has to work on its own merits, and we've gotten to a point where price is not helping demand at all. It's actually discouraging demand, and there is a lot of hedging that is taking place above that $4 level. So 409 stood in place again. That was the high way back when. That held up today. So we do need some more confirmation that weather is going to get just hot and dry, and right now we do have some rain chances and some cooling of the weather in the 6 to 10 day pattern. So that has allowed corn to hit that 409 level and back off somewhat. Over in beans, beans are going to travel a lot further than you expect, and they've already rallied $1 off of their lows for the summer, up to a level that probably should be sold at some point. I think we were 10.15 today. 10.30 is significant resistance. It has been for a while. And the rally in the beans is more short covering. Commitment of traders came out today, and looks like wheat, they're still short about 38,500 in the wheat. Corn, they're short 83,300, with them covering 59,000 contracts as of Tuesday. And in beans, they're still short 104,000, with them covering close to 50,000 as of the close on Tuesday. So, I believe the short position in corn probably is now more realistically around 50,000 shorts, and in the beans probably around 80,000 after these last few days. Like I said, weather plays a huge role in this. It's been flip-flopping somewhat, and we're looking at the 6 to 10 day to kind of determine if these lower temps do stay in here, or does the ridge that's out over the Continental Divide start moving into the western Corn Belt. Next week, going back to the crops again, we're looking at the safrinha crop coming out of South America, filling up the pipeline and stealing the business there as well. So you got to realize that somebody's taking advantage of these higher prices. They want to free up silo space for corn. There's a lot of beans in it down in South America right now, so I wouldn't be surprised to see a little bit more selling of beans, especially if that real can pull back a little bit versus the dollar. Next week on Wednesday, the focus will be on weather, and if that doesn't change, we're going to be pricing in for the supply and demand report out on Wednesday. We're looking at minimal changes there. Corn, we're looking at a 2.113 carryout versus 2.110. Realistically, you can drop down yield if you want to, but you probably have to drop down demand for feed and demand for ethanol as well, possibly even export demand, but I don't think the export demand will come through for a while. So that's where you stay kind of steady on the carryout for corn. Whereas in beans, they're looking for a 490 carryout instead of a 495. You do have to raise up exports, whether it be 25 million, 40 million, somewhere around there. You do have to take a little bit off of crush though as well. So I would imagine that you lose 5-10 million bushels is all in this report. A lot of times we do not mess with bean yields at this time, just because there's a lot more growing season left. We'll see what the government says about that. But you got to remember too that we've got a little bit more bean acres and a little bit more corn acres too to go into that equation. World corn is supposed to be about steady, same as world beans on Wednesday, so I don't see that being a significant factor. What we want to see is we want to see some rains in the plains area. We need a good soaker to go through the Midwest, and then all of a sudden I imagine we could say that some of these higher prices that we saw today would be the highs for the summer. We'll just have to see if the weather cooperates or not. So that is the wrap up for the first week of July. End of broadcast.